Welcome to this edition of How to Invest by Julius Baer. Today we delve into the intriguing world of crypto assets. But with thousands of coins and tokens available, how do you decide where to invest? Let's dive in. The advantages of crypto assets vary depending on the type of token. For example, Bitcoin famously broke the $100,000 mark for the first time in 2024. Known by some as digital gold, Bitcoin serves as a store of value and a potential hedge against inflation. Its addition to a portfolio can improve diversification and enhance overall returns. Meanwhile, Ethereum and Solana help facilitate transactions and power smart contracts. Now, this is interesting because it helps to automate processes and eliminate intermediaries. This technology offers speed, cost efficiency, and innovation. Large financial institutions are also exploring these platforms to reduce transaction costs by creating digital twins or tokenizing financial assets. Crypto assets also offer various investment pathways, so you also need to understand your options here too. The first and perhaps most obvious one is to have direct exposure through tokens, where you literally buy crypto coins or tokens using your dollars, Swiss francs, yen, or whatever fiat currency you have. The exposure can be over a centralized exchange, where the custody normally falls under this institution, or a decentralized wallet, where the custody is typically yours. This approach provides ownership of the asset itself, rather than a claim on the asset. But if this seems too much responsibility, instruments like futures and options can also be appealing. Bitcoin futures, for example, are traded on the Chicago Mercantile Exchange. And here, a futures contract would be, for example, an agreement to buy or sell an asset at a set price on a future date. Options, on the other hand, allow you the right to sell at a certain price, but it's not obligatory, so you have time to assess the broader situation. Exchange-traded funds and exchange-traded products are also an option, as they can either be directly backed by crypto assets or derive their value from them. But while ETFs and ETPs, as they're known, offer convenient exposure, they cannot be used for direct transactions like tokens, no matter how crypto solvent you are. Finally, investors could consider closed-end funds. Now, these are actively managed by a professional fund manager and provide exposure to crypto assets through a mandate controlled by them and their expertise. And this can be appealing for some investors who don't want to get too involved in the intricacies of the crypto asset market. Of course, investing in crypto assets comes with significant challenges. Crypto asset prices are highly volatile, and drawdowns, that's the decline from peak prices, can be steep. We've said it before, and we'll say it again. Managing emotions and risk tolerance is crucial. But despite these hurdles, the asset class has evolved. Institutional investors like family offices, pension funds, and even national funds now view crypto as a legitimate long-term option. This shift underscores its transformation into a global macro asset. The rise of crypto assets marks a significant shift in the financial landscape. Bitcoin in particular has cemented its place as a global macro asset, attracting interest from long-term investors' institutional mandates. For those prepared to embrace the opportunities and challenges, crypto assets represent a new frontier in portfolio diversification and long-term investment strategy. However, it isn't for everyone. It's vital to assess your risk tolerance and ensure you can sleep at night with your investment decisions.